Welcome to Currency Archive. Now, before we dive into what's really happening here, I need to ask you something important. If you've reached a point in your life where you value the truth over comfortable lies, where you'd rather know what is actually happening with your wealth than be fed another mainstream fairy tale, then do yourself a favor and hit that subscribe button right now. This channel isn't for everyone. It's for people who've lived long enough to know when something doesn't smell right. And I'm curious, where are you watching this from today? Drop your location in the comments. I want to know how far this message is reaching, because what we're about to discuss affects every single person holding physical assets right now. This might be my last upload. Please watch carefully. I need you to stop what you're doing right now, because what I'm about to show you is something I never thought I'd have to say publicly. For months, we've been tracking something disturbing in the silver market, something that doesn't just break the rules, it shatters them completely. 3 days ago, a specific event happened that changed everything. And since then, people have been reaching out to me, warning me, telling me to be careful about what I say next. This isn't speculation anymore. The evidence is right there in front of us, undeniable, documented, and honestly, terrifying. If you've been watching silver, if you've been wondering why nothing makes sense anymore, what I'm about to reveal will connect every single dot. But I need to warn you, once you see this, you can't unsee it. And the implications, they're far bigger than just silver. Welcome to Currency Archive. Now, before we dive into what's really happening here, I need to ask you something important. If you've reached a point in your life where you value the truth over comfortable lies, where you'd rather know what's actually happening with your wealth than be fed another mainstream fairy tale, then do yourself a favor and hit that subscribe button right now. This channel isn't for everyone. It's for people who've lived long enough to know when something doesn't smell right. And I'm curious, where are you watching this from today? Drop your location in the comments. I want to know how far this message is reaching, because what we're about to discuss affects every single person holding physical assets right now. Over the past 18 months, something unusual has been happening across financial education platforms, channels that focus on institutional market behavior, channels that analyze central bank policies, channels that document manipulation in precious metals markets. They have been disappearing, not all at once, not with explanation, just gone. Some creators wake up to find their channels deleted overnight. Others experience what the industry calls shadow banning, where their content simply stops reaching their audience. Videos that used to get hundreds of thousands of views suddenly struggle to reach a few thousand. Despite having loyal subscribers who never see the uploads in their feeds, this isn't conspiracy theory. This is documented pattern, and the team behind Currency Archive has been watching it closely, because they knew their turn might be coming. The pattern always follows the same sequence. First, a creator publishes content that exposes specific institutional practices, usually something related to derivatives manipulation, or central bank coordination, or the gap between official market prices and physical reality. The video performs well initially, engagement is strong, comments are thoughtful, the audience clearly values the information. Then something shifts. Within days, sometimes within hours, the algorithmic behavior changes. The video stops being recommended. It disappears from search results. The creator's subscriber notification system seems to malfunction, with followers reporting they never received alerts about new uploads. Next comes the comment section. Suddenly, dozens, sometimes hundreds, of new accounts appear. They don't engage with the content genuinely. Instead, they flood the discussion with distractions. Some aggressively defend the institutions being criticized. Others spread unrelated conspiracy theories designed to make the entire discussion seem unreliable. Still others simply post spam, burying legitimate viewer conversations under digital noise. This is coordinated activity. The accounts follow patterns. They appear in waves. Their language often matches, using similar phrases, hitting the same talking points. When analyzed, many of these accounts show no prior history of engaging with financial content. They exist solely to disrupt specific conversations. Then comes the final stage, policy violations. Content that has been live for weeks, sometimes months, suddenly gets flagged. Platform guidelines that were never violated before are now being applied retroactively. Strikes appear on the channel, revenue gets cut off. In some cases, the entire platform gets terminated, with appeals going unanswered. The creator is left with no recourse. Their years of work, their community, their voice, simply erased. And the information they were sharing, it disappears with them. Now, the Currency Archive team has watched this happen to others. They documented each case, they studied the patterns, they knew what signs to watch for. And recently, those signs started appearing on their own channel. A few days ago, they published a video analyzing JP Morgan's short positions in the silver market. The content was straightforward, factual, supported by publicly available data from regulatory filings and market reports. The video examined why recent silver price movements appeared coordinated. It looked at the timing of COMEX margin requirement changes. It documented unusual trading volume patterns that coincided with sharp price declines. Nothing in the content violated platform guidelines. Nothing was speculative or sensational. It was simply third-person analysis of observable market behavior. But within hours of publication, the comment section transformed. Hundreds of new accounts flooded in. The pattern was unmistakable. Some accounts posted aggressive defenses of JP Morgan, despite the video never making accusations, only presenting data. Others tried to redirect discussion toward unrelated topics. Many simply spammed the section with noise. The coordination was obvious. More concerning was what happened to the video's reach. Despite strong initial engagement from genuine subscribers, the view count stalled. The algorithmic recommendation system that normally distributes content to interested viewers seemed to shut down. Subscribers reported never seeing the video in their feeds, despite being notified about previous uploads. Then came the subtle platform warnings. No strikes yet, no formal violations, just suggestions that certain topics might be sensitive or require additional context. The team recognized these signs immediately. They had seen this exact sequence play out on other channels that no longer exist, and they understood what it meant. The information they were sharing had crossed a threshold. Someone, or some system, had decided this content needed to be suppressed. Now, this creates a difficult situation. Does the team stop covering institutional manipulation in precious metals markets? Do they self-censor to protect the platform? Or do they continue documenting what they observe, knowing that each video might be their last? They chose to continue, because what is happening in the silver market right now is not a minor story. It is not a temporary anomaly. It represents something much larger, something that business owners and decision makers need to understand. The physical silver market is experiencing a historic fracture from the paper derivatives market. The price divergence is unprecedented. The institutional response is revealing, and the fact that discussing this publicly triggers defensive reactions, that alone tells you something important. When information is suppressed, when platforms face pressure for sharing verifiable data, when coordination appears to silence specific topics, that is when the information matters most. This might be the last video from Currency Archive. The patterns suggest it could be, but before that happens, the team needed to document what they have been observing. Not as speculation, not as fear-mongering, simply as economic analysis that business decision-makers deserve to access. What comes next depends on whether the suppression pattern continues, or whether enough people pay attention before the channel disappears. January 2026 will be remembered as the month when a fundamental assumption of modern commodity markets broke down completely. For decades, market participants operated under a simple belief that paper contracts and physical metal trade at roughly the same price. Small premiums existed, of course, transportation costs, storage fees, regional supply dynamics, but these were minor variations, typically a few percentage points. That assumption no longer holds. Right now, at this very moment, physical silver is trading in Dubai at approximately $127 per ounce. Meanwhile, paper silver contracts on the COMEX exchange in New York show a price of $73 per ounce. This is not a typo. This is not a temporary glitch. This represents a 74% price divergence between physical metal and paper derivatives, the largest gap in modern commodity market history. To understand why this matters, one must first understand what this divergence actually means. When a business owner looks at silver prices online, when a financial analyst checks commodity quotes, when a treasury manager evaluates precious metals for company reserves, they typically see the COMEX price. That is the official number. That is what gets reported in financial media. That is what most people believe represents the real price of silver. But that number reflects paper contracts. These are derivative instruments, promises to deliver silver at a future date, financial instruments that can be created, traded, and settled without any physical metal ever changing hands. In fact, the vast majority of COMEX silver contracts never result in physical delivery. Traders settle in cash. They close positions before expiration. The paper market exists largely independent of actual metal supply. This worked fine, as long as everyone believed the paper price reflected physical reality. But what happens when that belief breaks? What happens when someone holding a paper contract actually demands physical delivery and discovers the metal is not available at the contract price? That is exactly what began happening in January 2026. The trigger was China's export restrictions. On January 14th, the Chinese government announced new controls on refined silver exports. The stated reason was national security. The practical effect was immediate. 70% of global refined silver supply became subject to export licensing requirements. China dominates silver refining, not because of natural resources, though China does mine significant silver, but because of refining infrastructure. Over the past 2 decades, Chinese companies built the world's most efficient silver processing facilities. They handle ore from multiple countries. They process scrap and recycled material. They control the bottleneck between raw silver and the refined product that industry actually uses. When China restricted exports, the global physical silver market fractured instantly. Buyers in Asia, particularly in Dubai, Singapore, and Hong Kong, began competing for available supply. Premiums spiked. Physical dealers raised prices not because they wanted to, but because replacement inventory was unavailable at previous levels. Within days, the premium over COMEX prices doubled, then tripled, then exceeded 50%, and it kept climbing. Meanwhile, something strange was happening on the COMEX. Despite physical market chaos, despite industrial buyers scrambling for supply, despite evidence of severe physical tightness, the paper price dropped. On January 21st, COMEX silver fell 6% in a single trading session. This made no sense from a supply-demand perspective. When physical metal becomes scarce, prices should rise. That is basic economics. Yet the paper market moved in the opposite direction. The mechanism behind this is well documented. COMEX has a tool called margin requirements. These are the deposits traders must post to hold positions. When COMEX raises margin requirements, it becomes more expensive to maintain long positions betting on higher prices. Traders with insufficient capital are forced to sell. This creates downward price pressure, regardless of underlying physical supply conditions. On January 20th, one day before the 6% price drop, COMEX announced an emergency margin increase for silver contracts. The timing was not coincidental. Now, some observers argue this is normal risk management. Exchanges increase margins during volatility to protect against default. That explanation sounds reasonable. But here's the problem. The margin increase specifically targeted long positions, traders expecting higher prices. It did not equally impact short positions, traders betting on lower prices. The asymmetry reveals intention. If the goal was simply risk management, both sides would face equal treatment. Instead, the policy specifically pressured buyers while protecting sellers. This creates a market structure where paper prices can be suppressed, even as physical metal becomes increasingly scarce, and the divergence widens. By early February, physical silver in major Asian trading hubs had reached levels that seemed impossible just weeks earlier. $127 per ounce in Dubai, $115 in Singapore. Premiums of 60 to 75% over COMEX had become normal. Yet financial media barely covered this. Business news channels continued reporting the COMEX price as the price of silver. Treasury managers checking commodity quotes saw $73. Portfolio managers evaluating precious metals positions used the paper price for calculations. Meanwhile, anyone actually trying to buy significant physical quantities discovered a completely different market. This is not speculation about what might happen. This is current reality. The implications for business decision makers are profound. Companies with industrial silver needs face allocation challenges. Manufacturers cannot simply order silver at COMEX prices and expect delivery. Solar panel producers, electronics manufacturers, medical device companies, they are discovering that official price quotes no longer reflect procurement reality. Financial institutions holding paper silver positions face a different problem. What happens when clients want to convert paper claims into physical metal? What happens when the 74% gap becomes common knowledge? And for business owners evaluating monetary hedges, comparing official inflation data against asset prices, the silver market fracture serves as a warning signal. When paper markets diverge this dramatically from physical reality, when price discovery mechanisms break down, when institutional interventions can no longer hide supply shortages, it suggests deeper systemic stress. The silver market is not isolated. It is a symptom. What is happening here reflects broader questions about the relationship between financial derivatives and physical assets, about the sustainability of paper-based price control, about what occurs when decades of market structure assumptions suddenly fail, and the fact that discussing these observations triggers defensive institutional responses. That alone confirms the information's significance. There is a principle in market dynamics that rarely gets discussed in business schools. When information threatens a profitable structure, the structure defends itself, not through argument, not through counter-evidence, but through information suppression. And right now, the silver market fracture represents exactly the type of information that institutional structures cannot afford to have widely understood. To see why, one must follow the money. The modern precious metals market operates on a foundation that most business owners never examine closely. It appears simple on the surface. Mines extract metal, refiners process it. Dealers sell it, investors buy it. But underneath this visible layer exists something far more complex and far more fragile. The derivatives tower. At any given moment, the total value of silver derivative contracts, futures, options, swaps, forwards, exceeds the value of all physical silver available for delivery by a factor of roughly 200 to 1. Read that again. For every ounce of physical silver that actually exists in deliverable form, there are 200 ounces worth of paper claims against it. This is not unusual in modern commodity markets. Derivatives serve legitimate purposes. They allow producers to hedge future production. They let manufacturers lock in supply costs. They provide liquidity for traders, but they also create structural dependencies. A small number of major banks act as market makers in silver derivatives. They take the other side of trades. They manage the book. They profit from the spread between buyers and sellers, and from the assumption that most contracts will settle in cash rather than physical delivery. These banks have accumulated massive short positions. A short position is essentially a bet that prices will fall. Or more precisely, it is a promise to deliver silver at a certain price in the future. If the price rises significantly above that contracted level, the short seller faces losses. Now, when short positions are modest and backed by physical inventory, this is normal market activity. But when short positions reach levels that dwarf available physical supply, when a handful of institutions hold concentrated bets that require silver prices to stay suppressed, the market structure becomes something else entirely. It becomes a system that depends on price control. The January 2026 fracture threatens this system directly. Because if physical silver trades at $127 in Dubai, while paper contracts claim $73 in New York, eventually someone asks an uncomfortable question. Why would anyone accept $73 for metal they could sell for $127? And if enough people ask that question, if enough contract holders demand physical delivery instead of cash settlement, the entire derivatives structure faces a problem it cannot solve through normal market mechanisms. There is simply not enough physical metal to cover the paper claims. The banks with massive short positions would face a choice. Either buy physical silver at market prices to fulfill delivery obligations, which would require purchasing at the higher physical price while having sold at the lower paper price, locking in catastrophic losses, or default on delivery obligations, which would destroy confidence in the entire derivatives market. Neither option is acceptable, so a third path emerges. Keep the paper price suppressed through margin manipulation and coordinated trading, and simultaneously limit public awareness of the physical paper divergence. This is where information control becomes economically rational from an institutional perspective. If business owners widely understood what is happening, if treasury managers began questioning why their silver ETF shares trade at 73 while physical metal costs 127, if corporate decision makers started demanding physical delivery instead of accepting paper settlement, the pressure on the system would intensify exponentially. But there is another dimension to this that makes the business community particularly threatening to institutional interests. Entrepreneurs and business owners represent network decision makers. Unlike retail investors who act individually, business leaders operate within professional networks. They discuss market conditions with peers. They share intelligence with partners. They make decisions that influence other companies' strategies. One informed CEO talks to 5 other executives. Each of those talks to their networks. Information spreads horizontally through the business community far faster than through retail channels. And business owners tend to act on information differently than casual investors. When a retail investor learns about market manipulation, they might buy some silver coins. When a business owner understands the same dynamics, they might restructure corporate treasury policy. They might shift procurement strategies. They might advise their board to reconsider financial hedges. The scale of impact is different. This is why content targeting the business community, content that presents institutional manipulation, not as conspiracy theory, but as documented economic analysis, represents a unique threat to existing market structures. It is not just about what people know. It is about what people do with that knowledge. And the silver market fracture provides a perfect case study in how financial markets can diverge from physical reality when institutional interests require it. Now, the team behind Currency Archive began noticing defensive responses, precisely when their content started reaching serious business audiences. Early videos on general silver topics faced no issues. Content discussing historical price patterns or basic supply-demand analysis performed normally within platform algorithms. But the moment the analysis shifted to institutional mechanisms, to COMEX margin manipulation, to the specific banks holding concentrated short positions, to the evidence of coordinated price suppression despite physical scarcity, that is when the algorithmic behavior changed. The pattern was unmistakable. Videos would launch normally. Initial engagement would be strong. Then within hours, sometimes less, the recommendation system would throttle distribution. The content would disappear from suggested video feeds. Subscribers would report never receiving notifications, and the comment sections would flood with coordinated accounts. This is not paranoia. This is pattern recognition. The same sequence played out after each video discussing institutional silver manipulation. The consistency revealed intention. Someone, or some automated system programmed by someone, had identified this content as requiring suppression. The economic logic is clear. Suppressing a YouTube channel costs essentially nothing. A few algorithmic adjustments, some coordinated bot activity, perhaps occasional policy enforcement. Meanwhile, allowing widespread business community awareness of the silver market fracture could trigger derivative market stress costing billions. From a cost-benefit perspective, information control is the obvious choice, and this is precisely why the suppression itself serves as evidence. When institutions respond defensively to factual market analysis, when platforms suddenly enforce policies against content that simply documents price divergences and trading patterns, when coordination appears to silence specific economic topics, it confirms that the information matters. If the silver market fracture were insignificant, if the physical paper divergence were temporary and easily explained, there would be no need for defensive responses. The fact that discussing these observations triggers institutional resistance, that Currency Archive faces the same suppression patterns that eliminated other channels covering similar topics, that tells business decision makers everything they need to know about information value. The truth is rarely suppressed when it is harmless. It is suppressed when it threatens profitable structures. And right now, the silver market fracture threatens one of the most profitable and most fragile structures in modern finance. The derivatives tower built on the assumption that paper and physical remain interchangeable, an assumption that is failing in real time. When a market's fundamental price discovery mechanism breaks down, it creates a cascade of problems that extend far beyond the commodity itself. The silver market fracture is not just about silver, it is a stress indicator for the broader financial system. And business owners who understand this early gain a strategic advantage that compounds over time, not through speculation, but through superior information positioning. The immediate question facing treasury managers and corporate decision makers is straightforward but difficult. Which price is real? If a company needs to hedge inflation exposure, if a manufacturer requires silver for production, if a financial officer evaluates precious metals as part of corporate reserves, which number should guide their decisions? The COMEX paper price of $73 or the Dubai physical price of $127? The answer depends on what the company actually needs. For purely financial exposure, for positions that will settle in cash, the paper price remains relevant. ETFs track COMEX. Financial derivatives reference COMEX. Accounting systems use COMEX. But for anyone requiring actual metal, the physical price is the only number that matters. And this creates a strategic intelligence gap. Most corporate financial systems are built around official price feeds, Bloomberg terminals, Reuters data, exchange quotes. These systems all report the paper price as the price. Meanwhile, physical procurement departments discover completely different reality when they actually attempt to purchase significant quantities. The companies that recognize this divergence early, that understand the implications before competitors, gain months of strategic lead time. They can adjust procurement contracts before physical premiums widen further. They can restructure hedging strategies before the paper market faces a confidence crisis. They can position themselves for an environment where physical assets decouple from financial derivatives. But this requires access to accurate information, and that is precisely what is being restricted. The second strategic dimension involves counterparty risk assessment. Many businesses hold precious metals exposure through financial instruments rather than physical possession. Silver ETFs, futures contracts, allocated accounts at major banks, certificates claiming metal stored in vaults. These instruments worked fine when paper and a physical traded at similar prices. But what happens when the divergence reaches 74%? What happens when someone holding an ETF share worth $73, representing a claim on physical silver trading at $127, decides they want actual delivery? The answer depends entirely on the counterparty's ability and willingness to fulfill that claim. Some institutions maintain full physical backing. Others operate with fractional reserves. Some can access physical supply through established dealer networks. Others would face severe difficulties sourcing metal at scale. Business owners rarely examine these details during normal market conditions. But normal conditions no longer exist. The silver market has entered a regime where counterparty analysis matters as much as price analysis. A paper claim is only worth what you can actually redeem it for, and redemption capabilities vary dramatically across institutions. The third implication involves supply chain resilience. Industries dependent on silver inputs face allocation challenges that financial hedges cannot solve. Solar panel manufacturers cannot build products with paper-silver contracts. Electronics producers need physical metal on production lines. Medical device companies require actual silver for antimicrobial applications. When physical markets decouple from paper prices, procurement becomes about relationships and allocation rather than simply placing orders at quoted prices. The companies that secure direct relationships with physical suppliers, that lock in allocation agreements before scarcity intensifies, that build inventory buffers while physical premiums are 74%, instead of waiting until they reach 100 or 200%. These companies maintain production capability while competitors face shortages. But this requires understanding the physical market dynamics that official price quotes no longer reflect. Now, beyond the immediate silver market implications, there's a broader strategic question business owners must consider. If the silver market can fracture this severely, if paper derivatives can diverge this dramatically from physical reality, if institutional manipulation can suppress prices despite obvious physical scarcity, what else might be similarly distorted? Silver is not the only market with massive derivative positions relative to physical supply. It is not the only commodity where a handful of banks hold concentrated short positions. It is not the only asset class where paper claims vastly exceed deliverable inventory. The same structural dynamics exist in gold markets, in certain industrial metals, in energy derivatives, even in government bond markets where central bank intervention has replaced genuine price discovery. The silver fracture serves as a proof of concept. It demonstrates that modern financial markets can maintain false price signals for extended periods, until suddenly they cannot, and when the break occurs, it happens faster than most market participants expect. Business owners who understand this dynamic gain a framework for evaluating other markets, not through paranoia, not through blanket distrust of all financial instruments, but through intelligent skepticism about official prices that seem disconnected from physical supply reality. The fourth strategic consideration involves information ecosystem navigation. As institutional pressure increases on platforms discussing these topics, as channels documenting market manipulation face algorithmic suppression, as coordinated efforts work to bury factual analysis under noise and distraction, access to reliable economic intelligence becomes harder. This is not accidental. Information asymmetry benefits those who profit from market distortions. The longer business owners rely on official narratives, the longer they trust paper prices that diverge from physical reality. The more time institutions have to manage their exposure before broader market awareness forces recognition. So building independent information networks becomes strategically valuable. Direct relationships with physical market participants who see actual transaction prices. Professional networks where business leaders share unfiltered market intelligence. Alternative platforms less subject to algorithmic manipulation. And perhaps, most importantly, verification skills. The ability to cross-check official data against physical market evidence, to recognize when reported prices no longer match procurement reality, to identify when financial media narratives serve institutional interests rather than factual accuracy. These capabilities separate informed decision-makers from those operating on delayed or distorted information. Now, regarding currency archives specifically, the suppression patterns documented in earlier sections suggest this platform may not remain accessible indefinitely. That is not dramatic speculation. That is probability assessment based on observed patterns. Other channels covering similar topics have disappeared. The defensive responses to recent content follow the same sequence. The institutional interests threatened by this information have both motive and capability to restrict its distribution. So the team behind this channel offers a simple recommendation. Do not trust this channel. Do not trust any single source. Instead, verify the data independently. Check physical silver prices in Dubai, Singapore, Hong Kong. Compare them to COMEX quotes. Calculate the divergence yourself. Contact physical dealers and request actual purchase quotes for significant quantities. The evidence either exists or it does not. If the 74% gap is real, if physical markets genuinely decouple from paper derivatives, if COMEX margin manipulation genuinely suppresses prices despite scarcity, then business owners can verify this through direct market interaction. And if the evidence confirms these observations, then the strategic implications require serious consideration regardless of whether Currency Archive remains online. Because the information is not about this channel. It is about market reality. And market reality does not disappear when a YouTube channel gets deleted. The silver fracture continues. The physical shortage intensifies. The derivative structure becomes more fragile, whether anyone discusses it publicly or not. The final question for business decision makers is simple. Do you want to understand these dynamics now, while there is still time to adjust strategies, while physical premiums are 74% instead of 200%, and while supply chain relationships can still be secured? Or do you want to wait until the fracture becomes so obvious that even financial media cannot ignore it? When every competitor scrambles simultaneously, when allocation becomes impossible and premiums become prohibitive, that choice determines who navigates the next phase of market stress successfully and who gets caught unprepared. The evidence is available, the patterns are documented. The implications are clear. What business owners do with that information, that is up to them. But they cannot act on information they never receive, which is exactly why platforms sharing this analysis face pressure. The question is whether enough people pay attention before the information disappears entirely.